For many people, marriage brings a vast swath of benefits, including financial ones. But if you have a significant other who believes that getting married is more of a financial liability than a benefit, don't be surprised, because that mindset is more common than you'd think. Many people have been confused by the long-held belief that married couples pay more in taxes than those who are single. However, not only is this largely untrue for many couples, but there are several reasons why marriage makes financial sense. Welcome to another episode of Health and Wealth. Subscribe to our channel to stay up to date with the latest uploads. But before we start, please keep in mind that we are not certified financial advisors. We simply provide informative and educational videos. So please do your due diligence when investing. Okay, let's get into today's video. Penalties and bonuses. America's progressive tax system can cut both ways for couples. Despite various attempts at reform, a marriage penalty still exists for some couples who earn about the same and are pushed into a higher tax bracket when their family income more or less doubles at marriage. This holds for both high and low-income couples. By contrast, couples in which one partner earns all the income, or significantly more than the other, sometimes benefit from a marriage bonus, because the higher earners bracket drops after marriage, and they end up paying less in taxes than if they'd filed separately as singles. In all, marriage bonuses can amount to 21% of a couple's income, while marriage penalties can amount to as much as 12%, according to the Tax Foundation. Eliminating marriage penalties and bonuses would require a significant rewrite of the tax code that would have far-reaching effects. Instead, lawmakers rely on marriage penalty workarounds. Social Security benefits. When married, you may be entitled to retirement benefits from Social Security that is 50% of your spouse's benefit. If your benefit is less than 50% of your spouse's benefit, this will apply to you. Qualifying will be dependent on whether specific requirements are met according to the Social Security Administration. This would also apply to divorcees that were married for at least 10 years and have not remarried. Ultimately, this provides more security to a spouse that earns significantly less than the primary wage earner in the household. The Tax Cuts and Jobs Act. The advent of the Tax Cuts and Jobs Act, or the TCJA, which was signed by President Donald Trump on December 22, 2017, led to several changes to the tax code that were intended to lower corporate, individual, and estate taxes. There has already been much discussion about how the tax code change makes only small reductions to income tax rates for most individual tax brackets, while awarding significant tax reductions to corporations. Also, the cuts that benefit individuals will phase out in 2025, but will remain for corporations and other entities. That debate aside, there is much new information for married couples to consider. The American Rescue Plan, signed by President Biden on March 11, 2021, included robust tax breaks to low and moderate income people. For example, in 2021 only, the size of the Earned Income Tax Credit increased to $1,502 for childless households. Individuals without children could claim Earned Income Tax Credit beginning at age 19 instead of the previous age of 25, and the upper age limit, 65, was eliminated. Earned income tax credit penalties and bonuses. The marriage penalty can be especially large for taxpayers who qualify for the Earned Income Tax Credit, or EIC, when one spouse's income disqualifies the couple. That said, marriage can boost the EIC if a non-working parent files jointly with a worker with relatively low earnings. A couple with $40,000 in combined income, split 50-50, for example, had a tax penalty of more than $2,357 in 2020, according to the Tax Policy Center. If this couple were not married, one parent could file as head of household with 2 children, and the other parent would file as single. Under that structure, they would have combined standard reductions of $31,050, which is $6,250 more than the new aligned $24,800 standard deduction for that income level when filing jointly as a married couple. When filing separate returns, the head of the household could claim an EITC of $5,779 and a child tax credit of $2,760. The other parent qualifies for neither credit. This means that the head of the household is due a refund of $8,404, while the other parent owes $760, for a total refund of $7,644. Had this couple filed jointly, they would have seen a far smaller EITC of $2,807, but a substantial child tax credit of $4,000. In all, their refund would be $5,287, which is $2,257 less than if they had been unmarried and had filed separately. A tax shelter is the opportunity to utilize someone's unused deductions. A reason to marry them? Probably not. But if the owner of a successful business marries someone who is not taking advantage of their tax deductions, they may be able to reduce their tax burden via a write-off. This may also apply to steep medical expenses. Though this thinking may not be romantic, it is a solid tax planning strategy. IRA contributions. The income ceiling for traditional and Roth IRA contributions is far higher for married couples in which one spouse has no income. Given that a spouse of an employed taxpayer may contribute to an IRA, even if they don't have a paid job, a couple fitting this description can sock away extra thousands of dollars for retirement, a total contribution for each partner, while achieving significant tax benefits. And if you're wondering whether such marriage incentives and disincentives have any effect on whether a couple will marry, they don't. That said, they do influence how much each spouse works. Traditional IRA contributions do have income phase-outs. For the tax year 2022, $68,000 to $78,000 is the range for individuals. For married couples filing jointly, it goes up to $109,000 to $129,000. And these amounts apply when the spouse making the IRA contribution is covered by a workplace retirement plan, according to the IRS. For Roth IRA, 2022 contribution phase-out ranges from $129,000 to $144,000 for single taxpayers and $204,000 to $214,000 for those married and filing jointly. Alimony no longer deductible, now taxable. While we're talking about marriage, or rather the end of one, a significant change under the TCJA is that taxpayers who pay alimony after December 31st, 2018 are no longer able to deduct their payments. Likewise, those who received their final divorce decree after December 31st, 2018 no longer have to claim alimony as ordinary income. Health insurance benefits. Possibly the largest financial benefit of getting married is health insurance, and the possibility of benefit shopping. If one person has access to company-sponsored health insurance, they can add their spouse to the policy for an additional cost. If both have access to health insurance, they can choose the best or cheapest plan. When couples enter a marriage and both have company-sponsored health insurance, they have to decide whether both should keep their insurance or whether one spouse will join the other's plan. Generally, coverage can be changed in the 60 days following the marriage. Remember that couples who get their health insurance via an exchange must enroll together, although each individual can choose a different plan. Also, if each partner receives a subsidy via the Affordable Care Act or the ACA when single, they likely would be penalized once they are married, as their combined salaries would probably push them over the cutoff threshold. However, the subsidy cliff was temporarily eliminated due to the coronavirus pandemic, potentially saving some enrollees thousands of dollars per year in 2021 and 2022. Married couples also tend to get big discounts on long-term care, or LTC insurance. This is because couples tend to care for each other at home for as long as possible, reducing the insurer's liability. Auto and home insurance benefits. By pooling insurance needs, insurance costs go down. Also, married couples are likely to get into fewer car accidents than single people. Multi-policy discounts and the lower price that comes with being married are just a few of the insurance benefits. Married couples may pay approximately 4% to 10% less on premiums for car insurance. Other discounts include multi-car policies and bundling homeowners insurance with auto insurance. Some home insurers offer discounts just for being married. Be sure to ask once you're hitched. Better loans for married people. 2 incomes are better than 1. If you apply for a $150,000 home mortgage as a single adult, you may have only your own income for the bank to consider. As a married couple, your combined income likely would allow you to qualify for a larger loan with better terms, assuming that your credit scores are reasonable. Just remember, that income isn't the only factor. Lenders also examine credit histories, total, and type of debt, as well as the borrower's debt-to-income ratio. If your partner is using finances as a reason to not marry you, their argument doesn't fare well against the facts. Getting married and staying married for the long term brings the opportunity for more financial security, provided that each spouse practices good family financial rules. Don't spend more than you have and limit or eliminate the use of credit cards. Also, do your research on managing money as a couple, which is a little more complex than you might think. Don't skip having an honest talk about spending habits, money anxiety, and goals. And with that, we've reached the end of this video. If you enjoyed it and you found it interesting, don't forget to leave a like and subscribe for more content just like this. Thanks for watching, and we'll see you in the next one.